Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to today's Top Stock Pick segment. I'm Jeremy Mullen, and I will be doing Clearfield, ticker symbol CLFD. The stock is the Zacks ranked number one strong buy that provides fiber protection, fiber management, and fiber delivery solutions. This enables rapid and cost-effective fiber-fed deployment throughout the broadband service provider space. That might sound complicated, but what Clearfield does is relatively simple. We all want faster internet, and this company is trying to make that happen. Fiber is a multi-billion-dollar industry that is growing rapidly, so the opportunity for Clearfield and others in this space is rather huge. Because of this demand, the stock has seen some relative strength in 2022, despite the market struggling all year. Clearfield is up 10% on the year, and this is after a large pullback over the last month. So the question going forward for investors is if the stock can bounce back to the 2022 highs this year. Well, if they can repeat last quarter's earnings, momentum will surely return. So I think this dip should be bought. But before we buy, let's talk more about the company, look at these previous earnings, check out what analysts are saying, and of course, we will look at what the charts are telling us. Clearfield was founded in 1979 and is headquartered in Minneapolis, Minnesota. The company employs 250 people and has a market cap of $1.2527 billion. The stock does have a Zacks style score of F in value and F in growth, so that's something to monitor as we sit in these long positions if you do end up buying it. The forward PE is high, it's 30, and in this kind of market, when people are looking for value, this is something often that investors will avoid. So if there was one negative about that, I would point out that. Now, the growth part really has to improve. Now, we'll talk about earnings and how much growth we are seeing, but this has to improve for the PE to improve for the stock to go higher. So those are going to be two things to look at going forward. Now, let's look at those earnings. As you can see, over the last, since 2018, it's really done well. We've only seen two misses, one in 2019, one in early 2020. And since COVID, there has been nothing, no red here, no misses, and a lot of big beats. So you can see that we are seeing some pretty nice growth in earnings power here. This was the worst quarter of that run right here, but we bounced back recently with a 37% EPS beat, and the stock took off after that. So let's look at that a little closer. This was in late July, and it was that 37% EPS beat for Q3 came with a revenue beat that doubled year over year, and with that, they raised their fiscal year revenue outlook. Revenues were taken for 2022 were taken to a range of 243 to 247 million versus the 218 million expected. Gross profit margin was down year over year, but their quarter over quarter backlog was up 16% to 157 million. The quarter actually saw new records for quarterly net sales and quarter end backlog. And management commented that they are, quote, making meaningful progress on our now of age strategic plan to expand our capacity and rapidly scale our business to meet the significant market demand for high-speed broadband, end quote. So that rapidly scale our business is something that they will need to follow through on in order to get that growth side moving. Well, investors cheered the news, as you can clearly see. They sent the stock from $85 to $100 in just a day. And this 15% move broke those previous highs here, and the stock eventually went all the way up to 130. So we'll get to the details in the charts, but let's look at these estimates. There's not a lot of eyeballs on this stock, not a lot of analysts. As you can see, Zacks only registers one, which has raised estimates over the last 60 days. And then, it's all higher across all these time frames. As you can see, for the current quarter, we hiked 10 cents. This is about a 14% hike. And then in the current year, we see a 13% hike. And then next year, even more optimistic, a 16% hike in estimates from 310 to 360. So Clearfield looking pretty good, according to one analyst. And another positive for the stock since earnings, there was news out that it would be added to the S&P Small Cap 600. So more eyeballs on the stock with that, more funds and money flowing into the stock. So this thing could just be getting going as far as the fundamental story. So let's look at the technical story. Let's look at the charts. Okay, so we have this amazing grind in 2020 that almost doubled the stock. And then in 2021, we did even better. Closed near its highs. But of course, in early 2022, if you're a tech stock, you got slammed and the stock lost almost 15%, 50%. But we saw some volatility with the market, but overall, this was just big consolidation between this 50 and 70. Mind you, this is tough to stomach, but all it was when you zoom out is consolidation before we had these earnings and the stock really took off. So quite the performer in a market that has gone down. A lot of tech stocks have lost 70% of their value. Clearfield has done amazing, right? So let's zoom in and see what else we should be looking at. Now, the recent sell-off, obviously, if you're buying up here, this is concerning because we had the 21-day break, which is the green line, and it fell right to the 50-day. And we saw some support, but the recent market weakness really brought it down. So what are we looking at now? Well, what I like to do is play with the Fibonacci retracements. So what I'm going to do is draw from these June lows to the highs. What that gives me is this halfway back. Definitely a buying interest area right here, whenever you have one of these halfway backs. Now, if the market continues to weaken, we could fall into the 61.8% retracement, which is a common place for people to step up and buy. Now, that would be this 82 area. If we get a bigger market pullback, perhaps the 200-day moving average comes into play. I don't see that happening. I see this buy zone between the 61.8 and the halfway back holding up, and at the very least, testing this 50-day moving average around the 100 level. So, traders, this is a good setup for use for some short-term games. Investors, you want to be accumulating longer-term position, because what you have is you have targets way up here at 150. So another way to look at that, if I take this off, let's just say that's the bottom. Another way to draw these Fibonacci retracements is to look at the extension. So we'll ignore this target down here if I was short. Let's just say this is the bottom. We get above the 50-day, get above the 21-day, and break 115. Let's say there's another good earnings move higher. What we then want to do is look at this 161.8 extension higher. So that's right where my, the $148 target is. So basically targeting 150. Now, when does this happen? I don't know. A lot of things have to fall into the lap of Clearfield. The earnings have to work out like the analysts are expecting. But the market sentiment has to improve as well, right? Otherwise, we may just consolidate in this area before perhaps next year moving higher and that fundamental story tries to play out. But yeah, this is a great looking chart, and above that 115, this thing is really take out those highs and get going into the end of the year. But the market has to cooperate, so let's not forget that. Clearfield has shown investors relative strength all year, so the current pullback should be viewed as a buying opportunity. Look for the current support levels to hold and for the stock to gain some momentum back into the end of the year. If the market can rally into Q4 and earnings can impress again, look for the Clearfield bulls to shoot for those all-time highs. That's it from my top stock. Here is Nina with hers.
Thanks, Jeremy. I'm Nina Mishra, and my pick today is Waste Management, ticker symbol WM. It is a Zacks rank number 2 buy ranked stock. Now, why waste management? It is because in this environment of rising rate and skyrocketing inflation, investors are looking for companies that can do well in a recessionary environment when rates are rising. And they're also looking for companies with very strong balance sheets and consistent cash flows that have been returning a lot of cash to shareholders and also putting that money in investments. And Waste Management is one of such companies, and as the name suggests, it is a leading provider of comprehensive waste management solution. You can read more details here. So it provides comprehensive waste management services. It is also a leading developer and operator of waste to energy and landfill gas to energy facilities in the United States. And that is also very important in the current environment. And we'll talk a little bit more about that. But let's take a look at the stock's profile. As I mentioned, it is a Zacks rank number 2, B for growth, C for value. And C for value because the stock is not cheap. It is currently trading at a forward PE multiple of more than 29 times, but the stock has been consistently delivering earnings growth, sales growth for the past so many years. And because it is a boring stock, very stable stock, so investors are willing to pay that premium. And in fact, you will see that the stock is in the green for the year, even though the S&P 500 index is down almost 19%. And the company delivered excellent results. And if you look at the detailed estimates code page, because of the results that beat both on the top and bottom line. And the company also raised its guidance, its outlook for the year. So you will see that analysts have been raising their estimates for the company in the past few weeks for the current year and for the current quarter and the next quarter and the year. And in fact, if you look at the longer term price consensus and EPS price chart, the stock has missed only once in the past 5 years. Now, I would encourage you to go to the investors day presentation on Waste Management's website if you want to learn more about the company, and there's some interesting stats and details about what the company has been doing. So the things that I like is that it has been investing a lot in automation. That is important, and investing also in recycling and generation of renewable energy. In fact, it is investing almost to 825 million over the next 4 years to turn methane into biomethane, which is a natural gas substitute. And we know that governments around the world, countries around the world they want to reduce their dependence on fossil fuels and Russian fossil fuels in particular. And that is why the transition to renewable energies has been accelerating. And some of the extreme weather events have also highlighted the need for more investments into recycling and cleaner energy. And Waste Management has been investing a lot in that, and that is important. Another reason which I mentioned earlier, that strong financial performance results in more free cash flows, and this company has been consistently growing its dividend, not only paying but has been increasing its dividends for the past 19 years, and also returning cash to investors in the form of share buybacks. So the Zacks rank number 2 stock is definitely worth a look. Check out zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, and I'll see you next week.